Hey everybody, thank you so much for checking the channel out today. My name is Agabus. This is your Financial Education Center, and we are going to take a look at the Bitcoin halving. What it is, why it takes place, and what implications it might have for the industry. We're over here at Cointelegraph.com to start off. Cryptocurrency tends to run on what's called a blockchain. So a block is a file containing 1 megabyte of Bitcoin transaction records on the Bitcoin blockchain. Miners compete to add the next block by solving a complex mathematical problem using specialized hardware, producing a random 64-character output known as a hash, finishing the process and locking the block so it can't be changed. And by completing these blocks, miners receive Bitcoin. So how does the Bitcoin halving cycle work? Well, miners were paid 50 Bitcoin per block when the cryptocurrency was originally established. Early users could be enticed to mine the network in this fashion, even before it was evident how successful it would be. The rate at which new Bitcoin was created decreases by half for every 210,000 blocks mined, or roughly every 4 years. The Bitcoin halving coming up in 2024 will be the next time, and it is projected that that 210th block should be mined anywhere in March or April. Let's take a look at why the halving occurs. Well, Bitcoin halving occurs as part of the protocol's design and is a key mechanism to control the supply of new Bitcoin entering circulation. The primary reasons for Bitcoin's halving are: number 1, scarcity and controlled supply. Satoshi Nakamoto, either the person or the group of people who invented Bitcoin, wanted to create a digital currency with a constrained and managed supply. Reducing the mining rewards by half decreases the rate at which new Bitcoin is generated. Due to its rising scarcity over time, Bitcoin has a valuable value proposition as a deflationary asset. Number 2, inflation control. The Bitcoin halving contributes to limiting excessive inflation in the Bitcoin ecosystem. The rate at which new Bitcoin reaches the market is decreased by lowering the block reward, and this restricted issuance process aims to keep the coin stable and valuable in the long term. Market forces and economics. The halving event has economic repercussions for both Bitcoin miners and the broader market. Miners must notify their operations to be profitable with a lower block reward, which increases competition and drives away less productive miners. This in turn can impact the overall security and decentralization of the network. So as you can see, the amount of new Bitcoin coming into circulation is less and less and less over time. However, the amount of people coming into the network or into adoption over time continues to increase and increase and increase. That is how you have a deflationary environment. And lastly, price impact. In the past, Bitcoin price rises have frequently been linked to halving events. Positive market sentiment and probable price appreciation have resulted from the expectation of decreased supply and rising demand. However, it's crucial to remember that past performance does not guarantee future results, and that factors other than halving affect Bitcoin's price. Now we're over here at Axie.com to understand a bit more about the Bitcoin halving and mining. As the Bitcoin halving mechanism again is built into the software, it happens automatically and doesn't rely on any third party or central authority. When transactions occur in the Bitcoin network, they are stacked into groups called blocks, and those blocks are roughly 210,000 that get mined. The Bitcoin protocol automatically reduces the reward that miners earn in half. A brief Bitcoin mining explained. Bitcoin operates in a decentralized environment, which means there's no central authority or central group to process transactions and ensure user honesty. So to address this issue, Bitcoin uses a process called crypto mining to validate transactions. This consensus mechanism is called proof of work and is used when nodes or computers in the network, called miners, solve complex mathematical problems to be rewarded with new units of Bitcoin. After a transaction is confirmed and verified by the miners, It's added to the block that becomes part of the Bitcoin blockchain and can't be removed. A block reward is given to the miner in exchange for their time and effort, provided the block is accepted by at least 51% of the network's nodes. And new Bitcoins are introduced into circulation through this process. Bitcoin miners can receive 6.25 Bitcoin as block rewards in addition to transaction fees. Then again, over here at Cointelegraph, the US Fed 2024 rate cut could prove perfect catalyst for the Bitcoin halving cycle. An increase in the U.S. Federal Reserve rate is considered bearish for the crypto market as it constrains the flow of funds into the market, while a rate cut is seen bullish as it boosts risk appetite among investors. Goldman Sachs, the second largest investment bank in the world, has predicted that the U.S. Federal Reserve could cut interest rates twice in the next 2 years, starting as early as the third quarter of 2024. With the much anticipated Bitcoin halving event expected in April, the crypto market could see a strong catalyst forming. But we shall see how this all plays out. Thank you so much for listening to the end here. As always, stay informed, stay inquisitive, and stay subscribed for more. We'll see you tomorrow and see what the halving brings next year.